thank you for joining us. I'm Angela McDonald, the Managing Director for Optimum Recoveries, and part of our mission here at Optimum is to help businesses stay in business through the savvy application of debt prevention management and recovery strategies. A large part of our core values falls within knowledge sharing as well. So we like to stay sharp and we like to share that information with others to help them to navigate business cash flow challenges. Some of those challenges have been outlined, and I will read this to you. The Zero Business Insight reports have been released, and what they're reporting is an overview of all of their subscribers. It's indicating that sales year on year are 10.7% down right now. Our time to be paid for those sales, so our cash flow, has had an additional 23.2 days tacked on the end of agreed terms. So if your agreed terms are 30 days, then you're likely to be paid around that 53 to 55 day mark, which puts pressure on your ability to do things with your money because it's outstanding that bit longer. We've got jobs are down and wages are up. And depending upon what happens at next week's elections, wages are looking at potentially going up further. Creditor Watch, a credit reporting bureau in Australia, released their business risk index today, and they indicated that national defaults or people not paying their debts on time and as and when they fall due are up 5.8%, and that's looking like it's going to continue to rise throughout 2022, and that there's been a dramatic increase in insolvencies, and that's expected to increase as well in the flood affected areas of New South Wales and Queensland. So potentially that's going to have a big impact on all of us in our businesses. We're already seeing some high profile insolvencies in the construction space, and Nikki will discuss some of those as part of her case study today. We present regularly, and we like to partner with area specialists to share their information, tools and techniques that can truly help make the difference between make or break in business. And trade credit is effectively a loan that a business extends to a customer to distribute stock and to build partnerships. But it is the old adage, a sale is not a sale until it's paid for. So it becomes a viable revenue stream when that payment comes through. The fragility of these commercial arrangements is painfully obvious when circumstances get in the way of businesses receiving payments on time. And but what that leaves us is with an opportunity for Nikki to share with us some information about how we stabilise trade credit in a shaky environment. So Nikki is from Marsh, a global leader in insurance broking and risk management. She is the trade credit growth leader and has over 25 years of experience in trade credit management. She uses her experience in this field to work with her clients on all aspects of trade credit protections, from facilitating risk identification to providing comprehensive solutions such as trade credit insurance. And she'll be leading us through our lunch and learn today to teach us how to use trade credit insurance to take control of what could be considered uncontrollable. Some quick housekeeping. Nikki has some great info in her slides to share with us today, but we have left a good amount of time at the end of the session for Q&A. If you do have a question as we go through, please feel free to type it in the chat section. And if we haven't already covered it in the presentation, we'll swing back to that at the end. So please join me in welcoming Nikki Pryer to demystify trade credit insurance for us. Thanks, Nikki.
Angela, and perfect intro into trade credit insurance. What is it and what does it cover? And hopefully by the end of the presentation today, I'll give you a very basic overview of what it is and how it can work and the improvements it can bring to your business. So our first slide, there we go. Trade credit insurance, what does it cover? So basically, when you have your business and you want to trade on open account terms, because not many people have the cash to pay up front nowadays, everybody expects a line of credit. So you sell your product, you give a piece of paper that says you owe me $10,000 but you can pay me 30 days, end of the month. So you now have to pay your supplier for product that you have given to somebody else because they haven't paid for it, on the expectation that they're going to pay on the due date. What happens when they don't pay? Now, the reasons that they don't pay can be insolvency. They have their own cash flow issues. It could be that you have sold overseas and there's an issue in that country, P&G, for example. Government says no more dollar out of the bank. So the trade credit insurance is there to cover any trade where there are open account trading terms, and it will trigger when the buyer fails to meet the payment obligations of that invoice that you've issued, and sitting behind that, the terms and conditions upon which you've agreed to trade. So the two main options that are covered, insolvency and non-payment for anything else, we class as protracted default. Those are the two main reasons why people claim on their policy or have the trade credit insurance policy. Our next slide gives some more in-depth information. So who does it apply to? Who can have trade credit insurance? Who does it cover? What does it cover? When is it of interest? So when do people start looking at the trade credit insurance? What structures can we offer? How does it fit? Is it going to fit my business? Because no two businesses are the same. No two businesses have the same payment terms. Everybody operates their businesses differently. So how do the wordings work? How do we work around the individuality of companies for our clients? What payment terms do they cover? Because again, not everybody offers the same payment terms. If we've got somebody on a 7-day cycle, we could have somebody that's exporting that needs a 180-day cycle. And how do we manage that? How do we structure a policy for that? And are there any country restrictions? So to start at the top, who does it apply to? It's anything really from a $1 million turnover company, which we affectionately class as an SME, which is lovely, through to corporates, banks, any type of commodity trader, and also whether they trade export and domestic sales. With the exports, the only country restriction there will be if there are sanctions. So at the moment, anybody trading into Russia, there is no cover on Russia. There's also no cover in some of the Middle Eastern countries. And each time there is a sanction, we're told, and obviously we don't like cover in those countries. What's the trigger? Well, that's the great question there. So normally, if a business doesn't know that trade credit is out there to help cover them and help manage their risk and their profile and their credit procedures, it's usually at the time of a loss and when it all starts to go wrong. But some businesses from startup are aware of the product and do co-seeking. It could be that they are looking for a line of funding to support their cash flow. So they go to invoice discounter, factor, that kind of arrangement through the bank, through a third party. And the bank or the third party funder doesn't want to carry the risk. In some cases, they will have their own trade credit insurance. And in some cases, they will say to their potential client, we're happy to give you this functionality to assist your business, but you need to go and get yourself a trade credit insurance policy. So if the risk transfer is what that relates to, if they want to improve finance terms that they've already got with the bank, so if they can show to the bank, hey, look, I'm happy to put you on my wonderful trade credit policy, can you cut me some slack on my fees and my charges? Because the risk now has transferred from the bank or from the funder to the trade credit insurer. Our most typical policy that we sell is where we call it ground up. So it's a very minimal excess of $5,000. It has 90% cover. So your invoices that you're trading, one invoice, 100 invoices to whatever value, 90% of that debt will be covered. So if we just put that into context with ProBuild, for example, and ProBuild owed you $10,000, you would receive back 90% of that debt that's owed to you minus the excess. If you don't have trade credit insurance, you're likely to get zero. So that is a big difference when you're looking at how you maintain your cash flow, how you can put money back into the business when you just haven't been paid. We also look at aggregate first loss. So for our bigger clients, not everyone is an SME. We have to tailor everyone, as we covered off. So we have an aggregate first loss, which is where you as the client will retain greater risk share yourself. So you're not really worried about all of this smaller, all of the transactions under 100,000, just for an example. But you're shipping out containers full of grain, and each container could be worth $50 million. That's where your concern is. That's what you're concerned about. You don't mind taking a hit on $50,000, but you do mind taking a hit on 50 million. So they will have an aggregate first loss, and that helps to draw down that premium for what we would charge. So the higher the aggregate, the lower the premium. And typically, because there is a risk share, any debt, once the aggregate first loss has been breached, the claim payment to the client is 100%. We also look at, again, going up a stage further for our corporate clients, is where they're looking just to their top 10. So that is a catastrophe style policy. If one of their top 10 customers were to not pay them or to fall over, it would be absolutely catastrophic. And that could be millions of dollars. So those are the difference. We go from, somebody turning over $1 million right up to companies that are turning over billions of dollars. We have one just recently, 1.7 billion. So that just gives you an idea of telephone numbers that we have to deal with. Each policy has a standard wording of general terms and conditions. But what we do, because each company is unique, we negotiate terms and a policy structure around a schedule that sits on top of those terms and conditions that is absolutely unique for the business that we're quoting for. So even though the general terms and conditions remain the same and they're the underlying part of the contract, the differentiator at what separates your business from a corporate, from an exporter, from an SME is actually the policy schedule. Again, we spoke about the terms of payment. So you may be offering 7 days date of invoice, 14 days date of invoice. Typical is 30 days end of month. So policies, again, can be tailored, and they'll take into account, depending on the size of the policy and what's involved. Typically, we'll see that it's 30 days end of month. There's also an extension period that is provided on top of that, because just to cover for companies that don't get paid on time. And so 90 days is a typical exposure that clients have before they are obliged to have discussions with us where we need to notify the insurer. So if it was a disputed debt, that's very different again to somebody that has defaulted and just hasn't got the money to pay you. And we differentiate those. Because it's a working policy, our teams work alongside your teams, and it's almost like we form part of your credit control team. We just don't sit in your office. And again, the country restrictions, as I said, we have sanctions that apply. So a good example there at the moment is Russia. If you were trading with Russia, we wouldn't be able to provide any cover there. That's really all the restriction that we have. Access to overseas licenses comes into play when we are looking at grouping policies. So we have a main policy here, but you may have a company that trades, for example, in India, and you want that policy or that company to be tagged on, your centralised credit control is from Australia. It's just that, rather have an agent in India, you have an actual company set up in India, and we can bolt that policy on using our license that we have in India. So that's what that refers to, all different things that we can do.
Great.
So everybody with me so far? It's kind of making sense, but yeah. Okay. So the benefits of trade credit insurance. You'll notice at the top there that it says it protects from bad debt. And you would probably think that that is the reason why you have a trade credit insurance. When I'm talking to companies that are exploring for the first time the trade credit option, I'm not looking to sell them a trade credit insurance policy to pay claims. I'm selling them a trade credit insurance policy to help grow their business and keep them away from bad debt. It's all well and good claiming on your policy when you absolutely need to. And again, I'll refer to ProBuild there, because that was now the blue insolvency that the insurers didn't even see coming. There was no forewarning for it, and Condev for that matter. That's what the policy is there for. It's not there to cover bad credit control. It's not there just to claim because you have it so that you can get into bad habits. And again, I liken that to, you don't buy insurance to cover your house, but burn it down every year to get the benefit of the fact that you pay the premium. So some companies absolutely look at this and think, now we don't have to do X, Y, and Z because we've got this. No. The trade credit insurance is there for you to grow and to keep you away from bad debt. So if you can apply for a credit limit, you don't lay awake at night worrying about, you've just let $10,000 worth of stock go. You haven't really got anything apart from maybe a mercantile report that doesn't give you the most up-to-date information. It gives you what's publicly available, but it doesn't give you anything more than that. And you're going to worry until you get paid. That's a typical scenario. So the trade credit, you apply for a credit limit, and that credit limit is approved and you trade. The risk transfer has gone from your mind, keeping you awake at night, because you know now that you've got the comfort. There's no adverse information there. There's no cause for concern. And so instead of selling $10,000, the risk profile came from the insurer that showed that it was a good company to deal with. So your salespeople need to be pushing sales towards that avenue, whereas applying for a credit limit and getting a no, because let's just say, for example, the director is, he's got a couple of failed entities. He hasn't paid his creditors. He's a sole director. He's got multiple overdue accounts because he doesn't pay on time. You've got other clients of the same insurer, maybe your competitors, who have the upper hand to say, well, we're not actually going to trade with him because we don't want that hassle. And that's where you use a trade credit insurance to stay away from those that are going to be a headache, that are not going to pay and have the potential to claim. And you make that call. If you want to trade with somebody, then you do so, and it's at your own risk. But you have the data there and the information to be able to make that informed decision. It also enhances your working capital. It embeds credit management disciplines. And because there are policy obligations that your credit team need to comply with, and that's where those disciplines come in. So we mentioned earlier that you have your payment terms plus a maximum extension period. And then once that extension period is breached, there is a requirement within 30 days to have a discussion with your trade credit broker, because there's a requirement to report through to the insurer. And the insurer then builds a picture of actually what's going on, because you may be being told one story when in actual fact there's a bigger problem. So you may think, oh yeah, that's okay, I'm okay with that. it's nothing serious, when actually they're not being completely honest with you, and there's a very serious major cash flow issue there. The sooner you can get in and deal with it and start collection and recovery action, the more likely you are to get paid, but the least likely you are to increase your debt position. And again, that last one helps grow your business. So that's one of the most important reasons why I look to help businesses and put this in place, because it's there as a credit management tool to help grow their business. Just on that little light bulb slide there, and again, just putting this into context, if your company is operating on a 5% profit margin, which is a little unique, I think, in this day and age, not many companies get that much, but, and you have 100 million bad debt, you've lost that customer, so you've lost those sales. You've had the bad debt, so now with trade credit insurance, you can claim, but if you don't have trade credit, you've lost the money as well. You've lost the product, but now you've got to go and find $2 million worth of new business to replace that one customer that you just lost. And that's also a big ask when times are hard. You've got to go out and compete. So it's not just you've had that loss. There's other factors that give CFOs and finance directors the biggest headache. It's not just the loss in terms of the dollar value and the invoice value and the product, but it's also the loss of that customer. So if we can ease that pain by, returning 90% of the money that's been lost, if you have PPS registrations, it may be that you can get stock back, so that reduces your bad debt position. You may have no claim or minimal claim. You've got your stock back and you can sell that on somewhere else. But that just puts into context the numbers there of what it costs a business when they do have a bad debt. Yeah. So who uses trade credit insurance? We've listed out some industry examples, but effectively it's any company that trades on open credit terms. Construction, obviously at the top, that's one of the most prolific users, and that is very broad. So from a trade credit insurance, the construction can be anything from somebody that is selling their bathroom wear into, a new build housing estate. So Hotondo, for example, was a Tasmanian home builder that went into liquidation, and our client was providing all of the bathroom wear for those new build properties. They went bust. The client had their PPS registration. They were able to get some of the non-fitted stock back. It reduced their claim value. But even though it's construction, it's not all about the building materials. It can be the air conditioners. It can be the plumbers. It can be the concreters. There's so many trades involved. And so that's why it sits at the top of the list there. Chemical and petroleum. Most petroleum companies have some form of trade credit insurance. Electronic manufacturers and distributors, food, agribusiness is another one, whether it's domestic or exporting. Trading houses, so your commodities, which could be steel, grain, pulp, seeds, that kind of thing, cotton. So there really is a broad spectrum. And I often, I'm very sad, but if I go to the supermarket, for example, and I'm trying to find, because supermarkets are very canny, they move things around so that you have to look and you buy two instead of just the one thing you want to pick up. But I like lime marmalade. So I'm looking for my lime marmalade. And while I'm doing that, I actually sit and think about what goes into that lime marmalade that I'm buying for $5 off the shelf. So somebody has made the glass, somebody has manufactured the actual marmalade, somebody has manufactured the sticker, somebody has manufactured the lid. The whole thing comes together and comes out through. You've got then your logistics of all of those manufacturings coming together to one and then shipping it out. Then it's sold to Coles. Coles put it on their truck and it gets in, and you're paying $5 for that one jar of marmalade. And I just look at things a little bit differently, and I think at any one of those stages, something could have gone drastically wrong, much as me. Recent insolvencies there. When we put together this slideshow, I just thought we would list 4 that people may not be aware of, obviously ProBuild being the biggest. Into food, that was huge. That was $50 million worth of creditors that didn't get paid, I think that was. But since then, we've probably 2, 4, 6, 8, 9. There's been another 10 that I'm just aware of. Next Group in New South Wales fell over last week. Evolution Group was a fatality of ProBuild, as was New Sensation. BA Murphy was another one. There was a high tech, I think it was, a glazing company that took probably 15 million worth of creditors. Home Innovation, Hotondo I mentioned, Inside Out Construction, ABD Group. Like the list just goes on and on and on, because when one of these fall over and somebody doesn't get paid, that then could put them into a precarious position and cause their own insolvency. If they had trade credit insurance and they were able to claim on their policy and get paid, that could be the difference between life and death of that business. So.
Nikki, why do you think, in addition to not having trade credit insurance in place, what do you think are the drivers of these entities falling over? Yes, we've had COVID, yes, we've had floods, but what are the other drivers of these organisations falling over?
One of the biggest drivers is the undercutting. So where they are competing for jobs and competing for work and constantly undercutting. So effectively, there's no profit margin. Bad credit management is another one where they over promise and under deliver, and they could lose the contract. I mean, there's many reasons why. One of the other ones, like I just said, would be the insolvency. So if they suffer a loss themselves, and you've also got the credit squeeze and the rising costs that we're seeing at the moment. So Worrells, for example, said that 90 days is an industry standard in construction to get paid. So if you imagine that you're supplying into the construction industry, and we said that that's very broad, 90 days, 3 months before you get paid. I mean, if I got paid my salary today, that's not going to last me 3 months.
No. And I think we forget that they also have retention monies involved in that as well. So they may not get paid in full.
Exactly right. So it's always that last, whilst you've got, you have that retention and you're still owed, you've still got that as leverage. But when that retention period is finished, there's actually no incentive there to get paid. And trade credit insurance can cover retentions. It's not something, it's kind of off flavour at the moment, and that's purely because of the position we're in. And obviously rising costs can't be overlooked at the moment as well. So, with the squeeze on the shipping issues, getting materials in, I mean, I don't know. What we see is that product comes in. For example, in the building industry, the timber, some of the home builders were sourcing their timber from Russia. Well, now they can't source their timber from Russia. So where do they go to get their timber? There's a shortage of timber in Australia because obviously Australia's used all of the timber. And even if Australia had timber, they've shut all the sawmills down. So then you've got the issue of, well, okay, we've got the raw timber, we've got the tree, but how do we get it into our 2x4 bits of wood that we need to make a roof truss? And again, Worrells were saying to us that for roof trusses, because of the issue just with timber, you could be waiting up to 9 months for a roof if you hadn't ordered your timber and been on the front foot. So there's variation of contracts is another blowout. So you could estimate the job to be, we've got this contract and it's $3 million, but the variations actually take it to $6 million. Nobody forecasts that you were going to have those variations. So when you're looking to the developer for more money because these variations have occurred, they haven't budgeted. And then so it's almost like a domino effect of what can go wrong. And there are so many requirements. So even looking at internal systems, it could be that their own invoicing system is so old, they don't have the money to update it, or it's too hard to update it. And I'm sure many credit managers that have to use this archaic systems can testify, but trying to keep up with the speed of today's world using yesterday's technology, you're always going to have issues. So, somebody might have a job, it's all done, it's all the work's going on, the contract's signed, the contract's accepted, the credit control office that's managing everything and trying to manage the policy sat in the office actually doesn't know what's going on over here. The contract starts, you're 3 months in, company falls over, you're owed $300,000. And by the time everything happens and everybody's looking at credit control to say, well, we've got a credit limit, haven't we? And again, that's where you get into problems of issues and not being paid. So,
thanks, Nikki. Should we move on to the next slide?
Yeah.
I asked that because I'm doing the driving, so double check.
Oh, okay, yeah. Poor terms and conditions is another one. If you're slack on your terms and conditions and you did them 10 years ago and you don't keep up with the way that the legislation is and how it changes and how it moves, when you come to rely on them, they're as much use as a chocolate teapot. So you lose before you've even got a foot in the door into the courtroom. So now you're on the hook for legal costs because you haven't had them reviewed. That's another reason, you're not reading contracts, you're writing poor contracts, but your terms and conditions are also a culprit to let companies down. So the whole ring.
Thank you.
Program types, as I mentioned back in the earlier slide, the $5,000 each and every excess, that's your basic roundup, whole of turnover, throw everything in the pot. The insurer has a very good mix, high risk, medium risk, low risk. The good risk helps dilute the bad risk. So cherry picking isn't really allowed, it's frowned upon, and it's not cost effective to do so. And that is the most common type of policy that we quote for day in, day out. But we do look at multi-buyer and key buyer. As I said, it all comes down to who the client is and what their business does and what their business requirement is. So it could be they're looking for a catastrophe type policy. And then the least common is single buyer because it is the most expensive form of trade credit insurance. So this is where a company is only looking to cover one customer. We used to be able to get terms. The markets at the moment are not so keen, and if they are going to look at it, the buyer needs to be really good on its grading. Well, if it's good on its grading, then why do you need to insure it? Okay, peace of mind. But the cost for that, you could potentially have a whole of turnover policy for less premium than you can have covering one single buyer. So it's hard to get, it's very expensive, it comes with conditions, and it is cancelable. So if that buyer gets into difficulty 3 months in, you could lose your credit limit. Normally they don't go into contract If it's doubtful, they do go in with a view of it being 12 months, but it could happen that there is significant adverse and they have to close down the policy.
All right, thanks.
How does it work? So effectively, once you've got your policy in place, you have your customer that you want to trade with, and you need $20,000 on ABC and go. So before you do anything, before you tender or whatever, you seek credit limit approval. So you apply to the insurer, can I have $20,000 on ABC and go? Positive decision comes back, off you go, you trade, you provide your goods, you send your invoice. Your terms of payment haven't been met, but that's fine, that's not frowned upon. You have your extension period. Typically, it's 60 days from original due date. That's industry standard. So we hit 90 days, you still haven't been paid, your credit control are pulling their hair out, they're not getting responses, complete shutdown of communication, and our 90-day, we hit the 90-day period. So that's when we start having those conversations. We're just not being paid, we don't know what's going on. We have an obligation then to report that into the insurer, and we do that within 30 days. So within 120 days, we're reporting into the insurer, and the insurer may withdraw the credit limit if there's a picture building up that it's something. It depends on who it is, it depends on how much it is. And so at that point, then we start to put it through the collection process. And if collection process is not successful and it's not big enough for legal, because obviously legal costs, if it's a $5,000, $10,000 debt, it's not worth paying for legal, the insurance will kick in and issue claim payment. If it is a $100,000 debt, the insurer will then start the legal process by obtaining judgment. Once judgment's obtained, we then lodge the claim. If it's an insolvency, we lodge the claim immediately, and whilst that is being assessed by the insurer, as a broker, we go off to the insolvency practitioner to get the debt confirmed. So you would have filled in your proof of debt and submitted that back to Worrells, whoever. We write to Worrells and say, hey, we act as a... and so we then start that process while your insurer's examining your claim. The two meet and the claim payment is usually within 30 days from the date of insolvency. So it can be that quick. If we get all of the data in, as soon as we've got that third-party confirmation from the insurer, the claim will be paid. Puts money straight back into the business, doesn't stop you, doesn't cause an issue with cash flow. So that's pretty much
what happens. I'm just conscious of the time for you, Nikki. I know you've got 2 case studies. Would you like?
Yeah, I might jump back to them and just go to the key questions.
You want to skip the case studies?
Yeah.
Lovely. There we go. Thank you.
Yeah. So these are key questions that you can ask yourself. And if you answer yes to any one of them, or this is when you should be looking at trade credit insurance. So the first one now, I won't run through all of them, but the first one, what would be the impact on your business if your largest client couldn't pay you? And if you just ask yourself that question and reality sets in, if you had the trade credit insurance, if the worst came to the worst and it happened, relying on the trade credit insurance to bail you out when, you know, your whole world's just caved in. And I've had business owners and credit managers call me absolute in tears because they're at the airport about to board a plane and they've just realised that their biggest customer's fallen over. It's the worst thing you want to hear. But knowing that you've got the trade credit insurance is awesome. How do you assess the creditworthiness of new and potential customers? So how do you grow soundly, knowing that if there is an issue, you're going to be protected? What do you do? How do you take on new business? Kind of the old Boy Scout way and just hope for the best? Or rely on a mercantile report that doesn't have the most up-to-date information and only what publicly available. You know, when did you last look at your top 10 customers and review their creditworthiness? And one of the biggest problems is, you know, we've always had them, they've always paid us late, they've always done this, or if they didn't pay me, they would tell me because they're my longest serving customer. If somebody has got financial troubles, they will not discuss it with you. Time and time again, we've seen, you know, well, they come for Sunday lunch or I play golf once a month with them. Doesn't mean they're going to disclose that they haven't got any money.
No.
What action do you take when an account becomes overdue? You know, when you're picking up the phone and sending an email, how far do you take that? And yeah, how do you monitor when you've taken on a new account? All of these questions come into play when you're looking at the reasons as to why companies then think, okay, well, I'm not comfortable with just one of those, so I'm going to have a look at trade credit insurance. And that's all you need to do. There's no obligation for us to provide you with a quote. There's no obligation for us to do a health check on your top 10 customers. And hopefully from that, you know, it will help potential clients that are thinking about it or looking at ways to help protect the business in these uncertain times, then trade credit insurance. And it's one of the only policies, if you think about it, it's discretionary, so it's not compulsory. But when you're looking at businesses, what is the most important aspect of a business? It's not the company cars, it's not the building, it's not the IT equipment, it's not the staff. The business exists because of its sales ledger. Without that sales ledger, it wouldn't be a business. You don't need the cars, you don't need the staff, and you don't need buildings. And yet it's one of the aspects of insurance that is overlooked and not taken. I don't get it, but I would say that I'm biased. So
thanks, Nikki. Should we jump into the key benefits?
Yeah. So most of them we've already covered off. So you know, it improves your cash flow. One of the things we didn't cover off is the competitive edge that it gives you. So if you have somebody that is trading very strict terms on 7 days because they need the money in, they've got tight cash flow, and you can go in and offer 30 days end of month quite comfortably because you're relying on the trade credit insurance policy to support your business. The insurers said, yes, here's your credit limit. You can do that. You're going to win that business. Again, it comes back to growth. It gives your sales guys the tools for them to be able to go and do their job, but do it safely and soundly. It protects the current assets, which we already know because you've got those covered and they're fine. And obviously you can help to grow the business. You can increase credit lines. You go to the bank, you say, I've got trade credit insurance. You get better rates, lower rates, because the risk transfer is not on you or the bank, it's on the trade credit insurer. The bad debt provision. So companies, they sit on money and they put it to one side, $3 million for a bad debt provision. No, free up the $3 million, put it back on your balance sheet and pay for the trade credit insurance. That is going to sit there and do a better job than having 3 million sat there doing nothing. And yes, the cost is cheaper than a lot of people think. So we can, minimum premium is $15,000 up to $10 million worth of turnover. So again, for the SME companies, to me, it's a no-brainer. We provide premium funding, so you can take the trade credit insurance, but all of the cost, GST, stamp duty, bundle it up and just pay monthly. And when you assess that monthly cost as opposed to not sleeping at night because you don't know if you're going to get paid or not, then that should help.
That's great, Nikki. Thank you. We've left a good bit of time, 5 minutes or so for questions. Would anybody like to ask a question? Just while anybody's typing to ask that question, or if you want to unmute yourself and ask the question, you gave some good takeaways there, Nikki, of solid terms and conditions make for good foundations. You've got international triggers. So like what's happening in Russia at the moment, it's cheaper than you think. One question that I had was around the compliance piece. So you touched on you've got to have good processes and procedures in place, good credit management practices. What are some things specifically that people should be doing to make sure that they're compliant with the policy and covered?
Well, that's actually where, as account managers, we help to keep companies compliant. So the biggest one is the reporting, because clients say, oh, you know, I have enough to do without doing that. But literally, we send out a reminder to say, hey, can you have a look and see if you've got anything sat typically in that 90-day column. So it's just a rundown that if it's greater than $5,000, we just need to know, we can have that. Yes, I do. Here's my overdue report. It could be that we have clients send in their aged receivables once a month. So we send out the reminder, they send back their aged receivables, we have a look at it, we go back and give advice. And quite often our account managers have actually picked up, well, I've seen this one on there, but I can't match it to a credit limit. So we close that gap on the exposure as well as looking to keep them compliant. And those are the key things. So reporting anything, if you, if you have a conversation with somebody, the old-fashioned thing would be to bounce a check. So if somebody bounced a check on you, we would need to know. If you become aware of adverse information, we need to know. All of those usual triggers. And then if there's nothing else, you have got that maximum extension period. So it's the reporting, making sure you've got cover on the correct legal entity. All too often we see slackness within businesses where they will invoice Hutches. Hutches isn't a trading entity. It's Hutchinson J. Hutchinson Pty Limited. So even without the trade credit insurance, if you go to court to sue Hutches, guess what? You're not going to get through the door because it doesn't exist. So we also help to educate clients with their invoicing, how they should invoice, what they can put. So yes, you can invoice Hutches so long as you've got a legal identifier for J. Hutchinson Pty Limited, such as an ACN or an ABN. But those are the biggest thing, making sure that you've got cover on the right legal entity and you're in line with your reporting. That's it.
Thank you. I had a question pop into my chat box. Did I hear right that you'll do a no obligation review of our top 10?
You heard right.
Yeah. Okay.
Yeah.
And so what would be the process that they would need to go through for that?
Basically, we just need, so I would send out, or via you, doesn't matter. We have a brief questionnaire and everybody curls at the thought of the questionnaire, but we need to know who the company is that is looking, because that comes into play of who you are, what payment terms you're on, who your customers are, loss history. And once we have that information back, it's on a 1 or 2 page form. So send that back through with your age receivable report, and that's enough to go. And we will review the markets, put together a report and send that back, have a discussion around it. And then it's absolutely no obligation. If you want to proceed, you can. If you don't want to proceed, then that's absolutely fine. But we look at the top 5 or 10 customers, depending how big the business is. So standard is 10.
It's a nice way to put your toe in the water if you haven't had trade credit insurance before, to go and find out more about it.
Yeah, exactly. And it's quite an eye-opener because we like comfort. Humans like comfort, and we fall into a comfort zone of you know, it's the same customer, or I'm doing this, or I'm doing this, and nothing's ever going to go wrong. But actually, you know, it could be that you're being paid because you are a key supplier to them, but there could be underlying problems where they're not paying left, right, and centre. You know, if they've not paid their ATO debt, for example, the ATO can wind them up. So how do you know? When, how, just because somebody has been trading for the last 5 years, and let's again look at, who was it? RCR Tomlinson. Were they a 100-year plus company that just fell over out of the blue? Right before Christmas, I seem to recall, and they had something like 28 subsidiary companies, same as ProBuild. So you just never know, and it's nice to have that data. So, you know, in our world, in trade credit, it's all about information.
Excellent, thank you. Would anybody else like to ask a question? Waiting for my box to pop. No, Nikki, is there any final tip or hint? I mean, what if I've already got trade credit insurance? How do I know I'm on my best deal?
Well, we can show you. We're happy to, if it's already something that you've got in place and you want to make sure that it is the best in terms of premium, it is the best in terms of the credit limit coverage that you've got, and it is the best in terms of structure, we're happy to go and benchmark that for you. We don't talk to your holding insurer, so we do need to know who that is so that we know not to approach them. So if you say to me, Nikki, my insurer is QBE, we go to the alternative market, not QBE. And what we come back with, so for clients, it's win-win, because we're either going to show their brokers doing an amazing job and there's no value add that we can put forward. Win-win, you know that you're on a good deal. Or we actually come back with a completely different policy structure and premium. So the premium might be more competitive. Just to give you an example, we recently did that and we saved the client. We got coverage, another 2 million of cover that they needed on Gurney Pty Limited, which is Harvey Norman. They were underinsured on Harvey Norman. We saw an extra 2 million and we got that approved through another insurer, but they saved $25,000 on their premium. So that was a clear case of the policy wasn't being marketed. It hadn't been marketed for many years. It was a case of complacency and the client had no idea. They just thought that the best job was being done. And so we do come across that. But again, that was a win-win because the client got more cover and they saved $25,000. So Marsh were appointed and we actually moved that policy to the other insurer.
So that's another great tip. Thank you. Never set and forget.
Exactly. Yes, we don't do that.
Excellent. Excellent. I appreciate that. Any final questions for Nikki? Or are we all feeling quite confident and comfortable with our exposure now to trade credit insurance?
Yeah, good.
No, we look good. Nikki, thank you so much on behalf of everybody for taking us on that tour through trade credit insurance and demystifying a few things for us. They're blowing up a few myths actually in terms of what is coverable, isn't, and how onerous some of the steps are to take.
Yep.
I like the fact that it's not as expensive as I thought it was. I always thought trade credit insurance was really expensive. So thank you for clarifying that.
Excellent.
What I would like to let everybody know about, so part of the process I mentioned earlier is that we do like to educate people, and we're continuing that next week with a session where we've been invited to present a face-to-face session at the Brisbane Business Hub in Queen Street Mall. And that session will be around debt prevention strategies in the current climate. And my co-presenter there will be Samantha Goddard from STG Legal. So if you're in the city next Tuesday at 9 a.m. and would like to come to Brisbane Business Hub at the beautiful theatre in Queen Street Mall, we'd love to see you there. Contact me and I'll let you know how to register. Otherwise, thank you everybody for an awesome session today, and thanks Nikki, our presenter, for clarifying things for us. And it's all lovely to see everybody.
Yes, thank you.
Lovely.
See you
All right.
later.
Thank you everybody. Bye
Bye.
now.